All right.
So it's 8 o'clock sharp. Shall we just start now?
I say so. Yeah, let's do it.
Yeah, lots of people are still coming up, but let's just start now. Welcome everyone to attend today's David Stech finally in Canada. I'm tonight's host, Christine Su, and David right beside me. And thank you everybody for joining tonight. We know today is Chinese Mid-Autumn Festival. So we really appreciate everybody spending their precious time with us. And I believe everybody here is eager to learn. So without further delay, let's welcome David.
All right, Christine, how are you?
Great.
Good.
So where are you now, David?
Pardon me?
Where are you?
Well, here I am in Puerto Rico. Now it's dark right now. If it weren't dark, you would see the nicest 1 mile stretch of beach in the Caribbean, and you'd see 7 layers of aquamarine. But right now it's not only dark, but it's thunderstorming right now. So with any luck, I won't actually lose the internet while we're doing this. So I was on an insider call on Saturday and I lost my internet during the presentation. So hopefully that won't happen. All right, you should be able to see my screen. Is that right?
Yes, perfect.
Beautiful. All right, let me just have my window up in the top. And if you can see it okay, then I'm good to go.
Yep, perfect. We're ready.
All right, well, welcome to everyone. I'm excited. It's been a while since I actually had a presentation in Canada, and this is the first one that I've had for a while where I presented to Canada. So I'm grateful for that. I don't know if you can hear in the background that we are having thunderstorms right now. And as I was just telling Christine, I live in Puerto Rico, and here I am in the middle of a thunderstorm with my fingers crossed that we don't actually lose Wi-Fi. So fingers crossed, everybody, say their prayers and we should be good to go. Now tonight, what we're going to do is talk about the state of the union for real estate investors. And I'm going to do an economic and housing market update. And I'm also going to throw in a little bit of history in terms of timing the real estate market, because I think you'll really find it valuable. And what I will also say is that while this isn't specific to Canada, all the things that I'm going to share tonight are applicable to any real estate market anywhere in the world. And so all you're going to need to do is think through your lens as a Canadian or as, a Chinese American or a Chinese Canadian or as any form of anyone who's looking at this as though they were looking through their own lens at the housing market in their area. And I promise you that you're really going to find it valuable if you do that. So without further ado, the 2021 State of the Union for Real Estate Investors, the new economic and housing market update. I always start with a disclaimer. And why is that important? Really because I want you to understand that while we have a family office, a company called Purpose Built Investments, while we have an insider group who have largely contributed to this education through they're making it compelling for me to treat other already successful people as true insiders. And I'm an individual. I'm not trying to be a representative of my companies tonight, although our companies spend an awful lot of money on research. I'm not an attorney or an accountant. I'm not offering any investment advice. I'm not trying to raise money. I'm not a doctor. My goal is simply to update you on the current economic and housing market the way I view it, so that you can be a better informed investor and you and your family can make better choices. And the only thing I would suggest is if you have an interest, make sure to write down now accessinsiders.com/Canada. And the only thing that you'll need to do if you go there is make sure that you register for future alerts for future webinars and that sort of thing. So before we get into tonight, I want to start by thanking the person who brought us all together. And who would that be? Christine, Canada's #1 money broker. I mean, how good is that? Well, this webinar simply wouldn't have happened without her. She and I are both part of a high-level mastermind group, and she asked me if I would share my latest market research, which is the insight that I normally reserve and only share with our insiders and those that are invested and have invested over the last 12 years in 10 of the funds that we put together. So I hope it'll help you. Why? Because this year, it really is time to thrive, not just survive like many folks did last year. So if you find value today, I want you to thank Christine. And why do I want you to do that? Because recognition feeds the soul. She's not trying to make money, and I'm not trying to make money from this. We're trying to help you position yourself to make more money. So what's our agenda? Well, it's not as long as I'd like it to be because we've got a limited amount of time. And what I would normally do is cover a number of things, but I'm going to have to avoid covering 2, just in the interest of time. What I want to do is really help you understand how to master the money game. Number 2, I want you to understand that research isn't something that's just nice. It's not just a bunch of charts and graphs. It's actually necessary. It's how we actually get to where we're trying to go a lot faster than we could without it. Because it's all about the when and the where. You see, when you're investing in real estate, it's about the when, the where, the how, the what, and the who. And the 2 singular most important things there are the when and the where. We'll talk more about that in a second, and you'll really understand what I mean by that. I'm going to get into an economic update, and it's going to be a US update, of course. But as I get into the housing market update, I've included some slides that I think you'll find value in relative to Canada. What I can't talk tonight about is being a contrarian. You see, I'm a contrarian. I generally do the opposite of what everybody else does. And I do that because I fundamentally believe that to be a contrarian puts you on a trajectory that you otherwise wouldn't have if all you did was follow the herd. I also love to talk about wealth accumulation. I also love to talk about wealth preservation, but again, I've got a limited amount of time. And in this presentation, I want to cover 1 through 5 and then share my last thoughts. So that's going to be a full hour. So let's get started. It started for me in a household that had no idea how the money game worked. You see, I had 2 parents who both had 8th grade educations. And my mom was one of 10 kids. My dad was one of 4. And those 14 siblings had 60 children. And I was the only one to go to college. Now, I can promise you, when I started in a trailer park, where that pickup truck that you see over there, that stub-nose Ford, was basically towing our trailer to wherever my dad could find work. And of course, I was a good-looking kid. In fact, not only was I good looking, I was great looking. Look at that. I mean, how much better does it get than that? Bow tie, freckles, and a buzz cut. I mean, how much better does it get than that? So I've gotten everywhere in life through my good looks. Hardly. It turns out that I actually had an idea. I had a concept. And literally over 30 years ago, I sat down at the kitchen table with my sons, and I tried to help them understand the money game. And I drew this triangle that you're going to see, and it hasn't changed at all from 30 years ago. You see, the money game never, ever changes, and we have mastered it. Now, I always tell people, 99% of the stuff in the world, I'm no good at. But when it comes to money and being able to turn on the money faucet, it's taken me a lot of my life to figure this out. But what I know to be true, and now you're going to know, is that it's really 3 things. 1, you've got to generate cash. The more income you can generate, the better. Now, you knew that. But of course, there's active income and passive income and recurring income, and every one of them is different. You've got to accumulate wealth. What's that? Well, it's really assets. And those assets both throw off income, cash flow, and they go up in value so that you always have more invaluable assets. And lastly, you got to keep it. You can't just spend it. You can't be taxed to death. You've got to figure out how to preserve it. So for us, we happen to do an enormous amount of private lending. well, our family really has done about 8,000 deals, and my son went on to create the largest private lender in America. In 4 years, he and 3 other guys that averaged 27 years old, the 4 of them created a $1 billion company in 4 years in the private lending space. He's now doing the same thing in the real estate investing space. And after 2.5 years, they're going to go through another round of financing in 6 months, and that'll put them at what's called unicorn status, which is a $1 billion company. Now, there have only been a handful of people who've done that twice in a row, and one of my sons has done it. My other son is also successful, and he lives here in Puerto Rico, not with me, but in the same building as I live in. So what do we do to accumulate wealth? Private lending. And Christine knows it as well as anybody. So for us, it's the only way to really scale and get big. As a flipper or as a wholesaler, it's very difficult. But in private lending, where you're leveraging other people's effort and other people's money and other people's time, you can really get to where you're going. Well, at the end of the day, with real estate investing, if you leverage appreciation and financial leverage, you get rich. And for us, we have Roth self-directed IRAs, you may have TFSAs, and I happen to live in Puerto Rico because as an American living in Puerto Rico under a tax decree, actually 2 of them, I can pay 0 to 4% income tax as opposed to the roughly 50% that I used to pay in the US. So I can look at that every day and know that every single day, my goal can be realized, and your goal, after you listen tonight, could actually be realized as well. What if you could make double-digit passive recurring interest income, regardless of your active income? What if you could reinvest it, you could keep it, you could optimize your effort to return ratio, and what if you could do it all from your backpack? That's literally what my family has created. And so my grandkids are going to have the benefit of being able to win the money game from anywhere in the world without a single piece of paper or a pen. That is freedom. And once you have that financial freedom, then you start clawing it back in the form of time freedom. And now we have it all. Now, I'm not trying to say that we're the smartest people in the world. I'm just saying we figured this out because we first realized that research isn't nice, it's necessary. Sure, it's a little nice, but it's fundamentally necessary. It's not okay to not know what's coming next, or you could be blindsided by it like so many people were back in 2006 and 7 and 8 and 9. Now, I know some of you view research as nice, not necessary, and I get it. The market run-up that we have had most recently in the US, but naturally in Canada as well. In the US, we bottomed out in January of 2012, and we've been on a tear. And in January of 2022, which is only a few months away, we will have been on a decade run-up. Well, any idiot could have made money in real estate over the last 10 years without looking at a single piece of data or analysis. You could have literally paid retail over the last 10 years for all your real estate and still made money because you had a tailwind. Well, it's my job today to snap you out of that because there's a history here. And we're now going through our sort of 4th real estate market cycle, and it's not over yet. So let's look back in time just to make my point. In 2005, if you were to look at the United States inflation-adjusted home price appreciation heat map, it didn't exist. What I'm showing you now didn't exist 17 years ago. Why? Because the technology didn't exist to be able to show what I'm showing. But what does it look like? Well, if you keep an eye on the colors over there on the left, on that legend, you'll see up in the orange and the hot red and the yellow, those are really strong appreciating markets. And the pink and the blue are really weak depreciating markets. Well, look at what the US looked like in 2005. It was hot, right? If you looked at California and Nevada and Arizona and Florida, which is my 4 favorite states out of all 50 states, what would you see? You'd see that it was on fire. Everything was doing well. Well, in 2005, I stood before a group of 2,000 people at Harvard Business School and said, get out of the market. Well, you can imagine how I was received. They basically threw me out of the room and said, this guy doesn't know what in the world he's talking about. Well, it took a while, but what do you think the map looked like in 2008? Well, by 2008, it was a mess. There wasn't one area in the country that was doing it all well. Well, when you look at a map like that and you realize that from 2005 to 2008, the market completely flip-flopped, now you understand how important research is. So in 2005, because no one else really did any research, virtually no one saw it coming but me. Now, I'm not saying I was the only guy on the planet that figured this out, but I was the only guy that stood in front of an audience of 2,000 people at one of the best institutions in the world and had the courage to say that it was going to blow up when there's no reason for other people to think that it might. And it's after I showed hundreds of slides that people still didn't believe it. Now, at the end of the day, homeowners in the US alone lost $6.2 trillion in equity from peak to trough. So success in real estate, and the reason I share that with you is it's all about the when and the where. Remember, there's the when, the where, the what, the how, and the who. Those are the 5 things that you've got to master in real estate to be very, very, very successful. And because we're market timers, we know the when and the where, and that has made us a fortune. Now, I've been doing this State of the Union for real estate investors really for 15 years and almost 16 years next year. And here's what I know to be true. You have to have courage when you're a market timer, because it doesn't always look like it makes sense when you present a forecast. And in 2005, when I said get out, I was literally almost thrown out. And in 2008, I was invited back and introduced as the guy that said, hey, get out of the market. No one here did. So what do you suggest doing next, Dave? And I said, get in Las Vegas. Even though it's the foreclosure capital of the world, I believe it's going to rebound and be the #1 buy market in the US by 2010. No one believed me, and I virtually got thrown out of that room too. Until 2011, when I got invited back, and now all of a sudden I had 2 previous experiences where I was right. So people started listening for the first time, and I said, the market's going to bottom in the next 12 months. I'm going all in and going everywhere, all in. Well, sure enough, it did bottom in January of 2012, and we've been on that decade-long run. Now, let's go back to 2008 and that heat map that I showed you about how bad it was in the US. And guess what? Canada was having its problems in a big way as well. Well, that's when I'm saying get in. And I'm saying get in the foreclosure capital of America, where 68% of all homes were underwater. In other words, their mortgage payment was higher than the current value of their home. Well, going into a market like that, where no one is investing, and it looks like a ghost town, you literally travel by 7 out of 10 homes and they're vacant. It was nuts. But at the end of the day, I believed that it was going to be the #1 buy market in the US by 2010. And sure enough, in 2002, when I first entered that market, the median price was $147. And I'll show you an example of a home that I bought in 2002, but I didn't close on it. I just signed a contract on it. We'll talk about owning versus controlling real estate in a minute. Well, a few years later, it had doubled in value. So what happened a few years after that? It had dropped 65%. And what about a few years after that? Well, if we fast forward to today, it's 381,000. Imagine buying homes at the bottom of the market when it was $100,000, like we were, for $60,000 to $65,000 at the auction, putting in $5,000 to $15,000 in rehab. Our all-in was $76,000 on that $100,000 home, and now it's $381,000. That is how you get wealthy in real estate. Contrary to what anyone ever tells you, it's not about cash flow, and I'll talk about that tonight. So here's a perfect example. Oak Bay Way. This was a property that in 2002, I put under contract with no intention of actually closing on it. Now, what do I mean by that? Well, in August of 2002, I contracted for $109,000 on a property that was going to be built in a later phase of a new development. It was supposed to be done by 2005, and it finally got done by 2006 because it was in the fourth phase of a development. It was a standard home, 1,456 square feet, 3-bedroom, 1 3/4 bath, 2-car garage, nothing fancy, standard lot. Well, less than 4 years later, something amazing happened. Remember, I don't own this property. I have a contract on this property, which means I'm controlling it, but I don't own it. Well, 4 years later, I assigned the contract 30 days before it was supposed to close. I never wanted the property. I was speculating that I thought that the values would go up and I'd be able to assign this contract to someone else. Sure enough, I did for $259,000 in June of 2006. So what happened next? Well, fast forward 4 years later. Coincidentally, we're at the auction and my bidder at the auction ends up buying this property for $61,751. Can you imagine that? I had flipped this home, basically assigned it for $259,900, and now I'm buying it back for $61,751. The first time I didn't even own it, I just controlled it, and now I finally own the property. Well, I rent it back to the previous homeowner who wanted to stay in the property because their credit was just destroyed, and I allowed them to stay in the property for 6 months, which became 12 months, which became 24 months. And eventually they moved 58 months later after their credit was repaired. Well, the crazy thing is when they moved out, I decided to spend $21,460 to rehab it. Remember, when I bought it at the auction, I didn't actually rehab it because the owners were in there and became my tenants. So when they moved out, it was time to now do something with that property. And so we spent $21,460 on rehab. And then we listed it for sale. And we ended up with an over list price offer of $175,000 in 2 days. Well, why is that important? Because when we closed on that deal and we were able to close in 25 days, we made $167,474. Why? How could we net $167,500 on 175? And the answer is we didn't pay a real estate agent to list it because we don't do that. We list all of our own properties, but we're happy to pay buyer's agents because they bring us what we truly need, a buyer. Because right now you can list any property, you don't need to have an agent, and you can sell it. Now, I feel bad for those of you who are agents on the phone because I'm not dissing on you. I'm simply saying that when you're at a hot market cycle, you can literally put an outhouse on the market and sell it. So that's what we happen to do. So now let's go back and do the math. Let's talk about this deal over 13 years when I either controlled it or I owned it. Well, in 2002, I signed a pre-construction agreement for $109,000 and I controlled the lot. I controlled the property. Well, fast forward to 2006 when I assigned the paper and I netted $150,900. I never owned the property, never made a payment. I literally had a piece of paper for $109 that became a piece of paper for $259,900. I didn't have taxes. I didn't have insurance. I didn't have utilities. I didn't have anything. All I had was a piece of paper. I love paper. And at certain points in the market cycle, I love real estate. Well, then I buy it back at the auction for $61,751. And now I'm owning it. Well, at the end of the day, I collected rent. And isn't it interesting? Almost exactly the same number that I bought it for $61,751. I collected rent for 58 months at the same price because I didn't even want to increase rent. I mean, I didn't need to take advantage of an already amazing situation with the person who was struggling from foreclosure. And so I made $60,900 in rent on a $61,000 property in 4 years. By the way, I then sold it for $175,000. netted $167,474. When you took out what I paid for it, my profit was 105. So my total, when you add it all up, how much I made on the assignment, how much I made on rent, and how much I made when I eventually sold it, was $303,600 on a 1,400 square foot home. Keep in mind that the cash flow represented 15% of total net profit. The other 85% were the three types of appreciation that allows you to get rich in real estate. Instant appreciation, where you buy it for a low price, a lot less than it's worth. Forced appreciation, where you do a rehab and actually improve the value. And market appreciation, where it takes you to where you ultimately want to go with a market tailwind called appreciation. Well, 15% of all the money I made was cash flow, and that was on the high side. Remember, if I would have had a mortgage on this, it wouldn't have been 15%. And that's why I believe that if you've got appreciation and if you use leverage by financing it, you can ultimately create wealth for yourself in real estate. So in our case, $333,000 in net profit, that's the equivalent of 127 years of cash flow at $200 a month. So I'm not saying cash flow is bad, but there's positive cash flow and there's negative cash flow, and I prefer positive. I either prefer lots of it, or I simply want it to be the glue that holds the deal together long enough for me to leverage timing. Well, that's what we're talking about tonight. And it doesn't just happen at the bottom of a market. Now, this is a flip, and I'm a private lender, so this was a home that I loaned on. It's not a rental, so it's a flip. Well, imagine that I funded it in January of 2020, right before COVID. And I loaned $188,000 for acquisition and loaned $45,000 for rehab. What was the rehab to be used for? It was to take the front of the house here, which was a porch, and convert it from the 160 square foot porch to a 160 square foot living area that would be part of the appraisal of a total of 1,110 square feet. Well, the after repair value, we estimated at the beginning to be 310. And in St. Petersburg, Florida, permitting is a pain. Well, permitting trying to do it during COVID was really difficult. So we didn't list the property, not we as me and the flipper, but the flipper himself actually listed the property a year later, a year after we funded the deal. Now, normally that's a bad thing if a deal goes too long, but with the tailwind we've had, you're going to see how it turned out. We had two offers on the same day. One of them was all cash, and it was over the after repaired value that we estimated a year before because of what we call the COVID tailwind. So my return was $61,000 on a $233,000 loan, or a 26% cash on cash return. Now, how much of that do I take credit for? Well, about 12% of it was actually COVID and the market tailwind, where it made this property more valuable than it would have been if it weren't for COVID, where I created, as a private lender, a preferred minimum return and profit escalator structure. Now, I'm not trying to get into private lending tonight, and certainly Christine knows a great deal about that. But at the end of the day, I just tell you this because you can make money in real estate at any point in the market cycle as a private lender. Whereas in real estate, you got to be careful about when you get in and out of real estate. Well, ultimately, what's the question you're trying to answer? Well, if you're anything like me, you're trying to answer for that green right there. You see, the green is the wealth phase of any market cycle. And I'm trying to figure out, are we in it or are we not? And with all the technical analysis we do, the fundamental analysis, the momentum tracking, the supply and demand data aggregation and analysis, what am I really trying to do? Is it because I want to show you a chart? Hardly. I want to know, and you should want to know, are we at a point in the market cycle where wealth creation is likely to continue long enough for me to justify making an investment now? That's it. That's all I'm trying to solve for. But boy, does it take a lot of money and a lot of time to get to the point where you know not only where we are, but what's coming next. You see, I'm not a contrarian, or I am a contrarian. I like to think exactly the opposite of what all those real estate gurus tell you when it comes to cash flow. And I said it earlier. For me, cash flow is simply the glue that holds a deal together long enough for the market to do my heavy lifting. And if I can buy it right and get instant appreciation, if I can do something to add value and get forced appreciation, and if the market does its thing at the right time in the market cycle, my goodness, can I make a fortune? And if I then finance that real estate at the same time, what's called levering up, that's when you get filthy, stinking rich. Well, we bought as many as 3 homes a day at the right time in the market cycle. And the key takeaway for you is timing is not just the most important word in real estate, it's the most important word in life. I think it is. Why? Because you met your spouse or your significant other at the right time, or your children who are your living legacy, they were conceived due to timing. So timing led you to this webinar. Timing led Christine and I to meet each other earlier this year. You think about that. The question then becomes, will you make the most out of what you learned tonight, like I did on one deal? I just showed you one deal that we've done really this year out of 8,000 that my sons and I have done in the last decade. So you've got to be able to learn something. But the answer is within you, not me, as to whether you do anything about it. So now let's talk briefly about an economic update. We have a lot of research partners, and I always like to start by thanking all of them, because without them, there's no way we could do everything that you see tonight. Now, what we know to be true in the US is that real gross domestic product in the second quarter grew 6.5% from the previous quarter, and this is after 6.3% growth in the second quarter. So we've had a nice rebound, 4 consecutive quarters of positive growth, but that's come with a lot of stimulus in the US. Remember, our government seems to like to spend money. I know Canadians are much more fiscally responsible than we are in the US. This stimulus has been, in my opinion, a lot more than was necessary, and we'll talk about it tonight. The real question I keep asking is, when are we going to get from recovery, which we're still in incidentally, to really this pre-recession level that we were at and get back to expansion? That's the thing I'm trying to figure out. And that's what you ought to be thinking about, because in the US, we added more jobs in August, but it was less than we expected. Leisure and hospitality, which was coming back in a big way, all of a sudden with the COVID spike has stalled. Now professional and business services and transportation and warehousing and private education like this, for example, is booming. Job openings now exceed hires by over 4 million people. So at the end of the day, there are so many job openings, but there aren't a lot of people taking it. Why? 2 reasons, and we'll talk about it in a second. First, all this stimulus has given people a cushion. It's made people lazy. They're not out trying to find work. They're trying to figure out why not to work. And number 2, we've got to put ourselves in a position where we encourage people to do what they've done in the past, not support them in a way that encourages them to continue to do what they've done the last 18 months. So right now, Americans have a savings glut because of all the financial support that they've had from the Fed. So a financial cushion is now the top reason for not searching for a job. In other words, when Americans are surveyed and asked, why is it that you're not searching for a job? They say because they've now got a financial cushion. Well, I got news for you. I've never had a financial cushion in my life. Starting in a trailer park, I didn't have any cushion. My cushion was 0. Well, at the end of the day, that's what inspires people to be on a quest for more, like most of you, or you wouldn't even be here. So at the end of the day, and look at the success that Christine has had. It's amazing. That's what you're trying to motivate yourself by and be inspired by. Well, in terms of inspiration, I can tell you that we had an uninspiring August jobs report. And as a result, GDP forecasts for the third quarter have taken a nosedive. So at the point where we were at last quarter, where we had 6.4% gross domestic product growth, it's more likely to be half of that. And in terms of personal consumption, it's gone down. In terms of domestic investment growth, it's gone down. So we're now regressing from the recovery that we had seen, and we weren't anywhere close to 2019 levels. So the 10-year Treasury yield has now responded, and basically what it's saying is that there's an expectation that the Fed will let inflation in the United States run hotter. In other words, go up beyond the traditional 2% that the Fed budgets for. The stock market, well, that's not anything that I care to try to understand. It's just not anywhere where I'd ever want to put my money because I can't control the outcome. And especially now, when the current price earnings ratio for the S&P 500 is approaching the historical high that we saw during the dot-com bubble, which, by the way, is higher than where we were during the Great Depression. So it's no surprise that an increasing share of Americans say the economy is on the wrong track, not on the right track. And it's back to near the peak when people had the most concern and the most uncertainty. There is pent-up spending. Why? Because people have been locked up in the COVID cave, and now they're starting to spend more. Sure, it happens on Amazon and online, but it's now happening more at the retail and hospitality level. So we've really blown past pre-pandemic levels. Well, how could that be? When the economy hasn't fully recovered, how is it that personal consumption has fully recovered? I'll tell you how. It's basically Americans spending the cushion that they've been given by the government, but frankly, they've been saving more than they actually been spending. Personal consumption is about 70% of economic output rather. And as a result of all of this, what's it mean? It means that the Consumer Price Index report is now showing signs of inflation. So right in the last month, we saw 0.5% price growth, which is 6% annualized. And you can see that we're now at the fourth straight month that inflation has increased at the fastest pace in 13 years in the US. Prices year over year have gone up 5.4%, which is almost 3 times what the Federal Reserve's target is. Now, the probability of a 1/4 point increase in the Fed funds rate in order to curb inflation is over 50% by the end of 2022. So basically, in the next 15 months, there's a good chance that we're going to see an increase in the interest rate. Now let's briefly talk about the housing market. And actually, it's not so brief, but I'm going to move through it pretty quick. And because this is being recorded, you're presumably going to be in a position where you'll have the benefit of being able to go back and look at this in more detail if you'd like. How do you really predict a correction or a crash? Well, it's interesting. I get this question all the time. And why? Because I'm a market timer. And it's really the curse of being a good market timer or a great one, that people think that you've got a crystal ball, that you're some kind of a magician. And they always want to know how you do it, that there's some secret sauce, and especially when you get it right. Well, I've had the good fortune of getting 4 corrections right out of 4 in the last roughly 20 years. And once you prove that you can call it right a few times, you get people basically begging you to give them the secret sauce. Well, here's my answer for anyone that ever asks that question. Why don't you look for the signs? Because they're all around you. In fact, there are about 20 of them. There are maybe more. In fact, we don't track more, but sometimes we look at others. And if you don't believe me, I'll give you a glimpse into both the qualitative and the quantitative signs that you should be looking for in any market. And these are in nature. I mean, you're always looking for quality and quantity in anything. So let's now talk about the quantitative side, the numerical side. How is supply in the US or in Canada? Is inventory in units or in months supply at a historic market high? The answer is no. Well, how's the demand? Is annual consumption outpacing annual job growth? And how about resale demand? Well, in the US it is. Well, what about new construction sales numbers? What are you seeing in Canada? Well, in the US, if we look at trailing 12-month total sales, are they up or down? They're not down. So if we look at share prices of publicly held builder stocks, are insiders selling off their shares to the public markets, and our home builder stocks below the overall market by 15%? No, they're performing quite well. What about affordability? Is it getting close to its historical worst, as in least affordable? I'm going to talk a lot about that tonight, but the answer is yes, in a big way. So if those are the quantitative measures, and those are only 5 of 10, what about the qualitative? Well, is the mortgage industry getting creative? Are you seeing ads for 100% financing, interest only, or no doc loans like we used to have in 2005 in America? Yeah. Well, what about regular people owning multiple homes? Is your Uber driver or your dog groomer telling you about their second and third home purchase? Well, don't look at me like I've got 2 heads. Canadians were in the same boat as Americans back in 2005 and 6, when people had gotten out of control, speculating that prices would never go down. So the answer is we aren't seeing a lot of that right now, not yet. How about real estate industry people? Are they living the high life? Do you see salespeople and mortgage lenders living like it's never going to end? Actually, we're not seeing it yet. And how about builders? Are they speculating in more remote areas? Are they going from primary to secondary to tertiary markets and doing land acquisitions that are currently a little more than truck stops? Yeah, they're banking on a shortage. And are these building industry trades courting builders with lavish parties? Is it becoming clear that the trades will spend on entertainment to secure partnerships with builders? Yeah, we're seeing a lot of it. Now, those are 10 of 20 bubble signs that we track. And 5 of those are already yeses. So what about the other 10? Well, I could share them if we had the time, but I'm going to try to push through and get through over 100 slides as it is. But perhaps we'll do something like this again in the future, depending upon whether you tell Christine you hate it or you love it. So while I hate to do it to you, it's like teasing you. Hey, guess what I did Saturday night? I can't tell you. Well, I don't want to do that, but at the end of the day, we're just time constrained right now. But what I will say is, if you are interested in this kind of webinar, if you do see the value in research and strategies and blueprints that lead to opportunities, just go to accessinsiders.com/Canada, where we've set up a way for you to be able to register for this in the future. And it's really easy. But for now, I'll just say a bubble's a real possibility. So let's explore it in more depth as we go through this today. If we look in the US, and this is not a lot different in Canada, but you will see some differences in a second. This is the hottest market I've ever seen. And that's saying something. I mean, there is really nothing on this map that you should be concerned about if you're in America, except the fact that it's the hottest market we've ever seen. So in 2005, when I spoke at Harvard, I said, look, right now we have been on a tear. And I believe that the market is at or near its peak. Well, if that's true, and if we apply the 80-20 rule, that means it's got 80% downside and 20% upside. Could it go up? Sure. Could it go up a lot? No. Could it go down? I think so. And I think so. I think it's going to go down hard. Well, fast forward to now. We're 15 years later. We've had a recovery. We've had a 10-year bull market. So where are we now? I don't know. I'm starting to get nervous. I believe that when you're at or near the bottom of the market and you know it like we do, you're an investor. I believe when you invest at or near the top, like we believe we are, you're a speculator. And I'm not prepared to speculate in real estate right now. I am prepared to invest as a private lender, to get in, get out, profit, move on. Get in, get out, profit, move on. That's why it's so important. And obviously, Christine's cracked the code on that as well. But when we look at a market that's that hot, we all have to recognize that there is no real estate market in the US. There's no Canada market. Canada and the US is made up of what are called MSAs, metropolitan statistical areas with minimum population bases. We have counties, you have provinces, we have census tracts, we have neighborhoods, we have homes. Real estate in the US is simply a sum of everything that's going on that map. There is no US real estate market. There's the sum of what's happening in all those little local markets. So momentum indicators will always show the energy behind every market if you know what to do. And because we spend so much money to try to figure this out, we're really looking for momentum markets. Now, there's something called the advanced decline momentum indicator, and it's still bullish, but it's showing that fewer markets are appreciating right now, quarter over quarter. Now, I don't want to try to explain this, but just know that the blue line is an inflation-adjusted overall appreciation rate, and the red is the percentage of all the markets that have increased in value. So we look at this as a measure of what we call market breadth, and that can act as an early indicator for changes in the market cycle. Now, is it more important to get in or out of the market at the right time? That, Christine, should be a question that everybody ought to ask when it comes to the chat box and the Q&A at the end. What's more important, to get in the market at the right time or get out of the market at the right time? So be thinking about that during the rest of this, and I'll answer a few questions at the end. Technical analysis is different than fundamental analysis, but they're both the ability to be able to look at a nuanced picture in the US and figure out if supply and demand data can create sort of an algorithmically derivation and apply it to the current market. So we look at both fundamental and technical analysis with one goal: to derive trends that give reliable and irrefutable guidance to our next move in the market. That's what we're trying to figure out. What do Americans think now? Do they think it's a good time to buy or a good time to sell? Well, the number of Americans who think it's a good time to buy fell 38%. So we're now at the point where it's the first time in the survey's history since back in April that we've actually plummeted. Buyer sentiment is really starting to soften. Will it have an effect on actual demand, and as a result have an increase in inventory or month supply? I think it will. Back in April, realtors in the US were reporting that buyer interest was very strong in 80% of states. Not strong, not moderately strong, not weak, but very strong, like the highest measure. That was April. Fast forward 3 months. In July, buyer interest has cooled off in 44 out of 50 US states. So when you're looking at the market, and when you were back where I was in last quarter and telling people things are going to start softening now, we realized that there's a difference between being a real estate investor and being a real estate agent. A real estate agent is trying to sell a home to a homeowner. A real estate investor is trying to invest in a house that they can sell to a homeowner at some point or keep it as a rental property. Well, on an index of 1 to 100, agents rate current sales at 65, which is closer to fair than good. But they expect over the next 6 months that it'll be at an 83.1. In other words, they think the market's getting stronger, not getting weaker. And my opinion is maybe they're right, but I can tell you that they're generally optimists about real estate. And right now, I don't see what they believe to be true. Meanwhile, buyers and sellers don't see it either. If buyers, 38% now think it's not the best time to buy, what about sellers? Well, it's dropped about 7%, but you can see that there's a big difference between the number of people who think it's a good time to buy, increasingly less, and the people who think it's time to sell. Now, that may be because sellers are sensing softening demand from buyers, but still 75% of sellers think it's a good time to sell. I agree with them. This is the time to sell. That's my opinion. You don't have to subscribe to it. I'm just telling you what I believe to be true. And I'm going to share in a minute why I think that's the case. Seller interest as of July is quite a bit lower across the board. where you can see for the first time some very weak and some stable and some weak marketplaces. So we know that 75% of respondents say, yes, is it a good time to buy? But they're not listing their homes at the rate that they're saying yes. Pending sales in terms of demand. Remember, these are escrows that are opened for which there are pending sales that have yet to close. Those are up slightly, but they're still on a marginally downward trend, but still up 8.6%. So you should expect more listings, which adds to more supply, if you believe 75% of people think it's a good time to sell. And if hypothetically pending sales were to continue to drop, what that would do is see a downward pressure on price. Now, what's going on now is almost incredible. 63% of homes 3 months ago were in pending sales and under contract within 2 weeks. It's still 48% in the US. So it's not as strong, but it's still strong. So what we're seeing is very slight downward trajectory for the last few months. And the question is, what's going to happen moving forward? Well, look at unit sales in Canada. They've dropped from July to August, and they've fallen noticeably from the first quarter and the second quarter in terms of residential sales activity. And in terms of unit sales, they're trending back down toward the 10-year monthly moving average. Now, that's important to know, because as an investor, you're trying to figure out, is now the right time to invest? And as long as there's market momentum, there's not going to be a big difference between the current value and the price that you could pay for it. The number of new listings in the US dipped for the first time below 100,000 units in June, and less supply is coming on the market to meet the demand that's there. So I think it's going to continue to put upward pressure on prices. We're going to talk about why that won't happen forever in a minute. If we look at Canada and we look at new listings, they're down quite a bit in the third quarter, as you can see. The Canadian ratio of sales to new listings has been dropping since late in the first quarter. Now, if you go back to the US and you look at months supply, it's still insanely low at 1.2 months supply. And here's the thing, most markets can have healthy price appreciation with 3 to 6 months supply. In other words, there's plenty of room for this frenzy that we've had in the US to cool down, for month supply to go up, and still see some form of price appreciation, but not forever. So I do think it's reasonable to assume that technology's created a new normal where homes can be shown. And 63% of homes have been shown over the last 3 months and resulted in offers online. In other words, people aren't actually looking at a home. Let me restate that. People are buying sight unseen. It's such a frenzied market. So inventory in units has been trending up little by little, but just by a little. And median list price is up over $30,000 last year, which is about a 10% increase. So as you see, not just in the US, but when you look at Canada, prices are up year over year in every province. So the question is, what's coming next? And are we at or near the bottom or at or near the top of a market? And it'd be hard for anyone to convince me, and for you to be delusional enough to convince yourself that the market is at or near the bottom, or that it's halfway up the curve. I believe that we are going to see a correction. Will it be a crash? Absolutely not. The fundamentals are not in place for that to happen. But if you look at, again, on average, prices in Canada have dropped since the first quarter. They're still climbing on a seasonally adjusted basis, though. So when we look in the US, we see median sales price up. We see it up in percentage terms and in dollars, but down a little bit from its recent peak. So it's lost its momentum. And yet 46% of consumers expect home prices to rise over the next 12 months. Why? Well, where did they get their information? One place, the media. Their real estate agent has no idea what's going to happen in terms of prices, because they don't do the research that you and I might do as an investor, because we need to know what's coming next. We're trying to buy houses and turn them into homes, and they're trying to sell homes. Again, it doesn't mean as an agent, you're a bad person. It just means you don't do this kind of research because you don't think like an investor, you think like a salesperson. So this continues the slight downtrend that we started in April, and overall 25% more Americans expect prices to go up than go down. If I were to guess, I'd say Canada would tell you the same thing. Keep in mind that a continued price rise would send us into the global financial crisis price to income ratio. If you go back and look at the peak of the housing bubble in 2006 and 7, you'd see a ratio of 7.03. And we're currently at 6.79. And look at how much of that increase has happened over the last couple of years. And were we on a trajectory from 2012 and 14 and 16 and 18 and 20 to be where we are now? No way. So it's got to be the COVID tailwind. And how long will that last, and why is it even happening? Because there's so much incentive, otherwise known as trillions of dollars that are being pumped into the economy now. People are using it largely to fill up their bank accounts, and some of it to spend money on some consumer goods, but not enough. And the one bright spot in this whole market is housing. Well, as people come out of the COVID cave, they're going to have more options to spend money on than housing. So during this cycle, home price appreciation has outpaced income growth, driving the home value to income ratio higher, and we expect it to increase further over the next 2 years until it finally reaches a point where it's not sustainable. If we look at surveys of real estate professionals, they believe we'll be in a bubble if prices rise another 10%. In fact, if you look at that graph in red, you'll see that 27% of people who are professionals in real estate in America already believe we're in a bubble. And if it goes up another 10% in price, 44% combined. But if it goes up 20%, 80% of real estate professionals will believe that we are officially in a bubble. Well, what does that mean? It basically means that the higher the price to income ratio goes, the more affordability becomes a problem. And I believe if you look at that aqua line there, that we will continue to becoming increasingly unaffordable until we finally hit a ceiling. And that's where you can see where I'm projecting that ceiling to be. Now, what do I really mean by all this? Well, what is affordability and the affordability index based on? It's based on 3 things. 1, sales price, how much does something cost? 2, interest rates, how much does it cost to finance it? And 3, income. What's your income compared to your monthly payment on the sale price of the property that you're trying to buy? Well, at the end of the day, we are seeing declines in affordability across all the indices we track. So this one happens to be from the National Association of Realtors that's indicating that affordability declined in June as median family incomes rose by 2.3%, while mortgage payments increased by 21%. Now, did it increase because of interest rates? No, it increased because of sales price. Okay, fortunately, interest rates for 30-year fixed rate mortgages in the US continue to be low, still under 3%. Now, mortgage applications, while they've increased slightly, are at the time of the year when they historically decline, and they are. So at the end of the day, that is an important metric to keep an eye on, because mortgage applications obviously precede closings. So you don't see it show up in terms of sales, but you do see it show up in terms of applications. According to NAR, the National Association for Realtors in the US, 49% of all finance buyers are putting down less than 20%. Now that includes 72% of first-time buyers. Bottom line, if you wrap it all together, buyers are putting more money down, especially move-up buyers, because they have a historically high equity position in their homes across the United States, and interest rates are low. So they're putting more money down to basically buy down their monthly payment at the lowest interest rate that they can. Put another way, down payments are either the same or higher compared to those pre-COVID, where 90% of real estate agents report that buyers are using down payments that are either similarly sized or larger than they were before the pandemic because they now have stimulus money. So what does that tell you about the current affordability picture? Now, you may think I'm just about to poo-poo the whole thing, and I'm not. Affordability has not yet become a problem, or prices would not continue to climb. And at the end of the day, I think larger down payments are due to two things. One, the Americans' increase in savings during the pandemic from all the stimulus money floating around, $5 trillion to be exact, and the increase in price that's led to an increase in their equity in their homes. So now they're able to move up. They're able to move out. And what we're seeing are significant trends in terms of out-migration, and we'll talk about that as well. But here's the bottom line. On higher priced goods like real estate, the affordability picture will likely change for the worse. It only has so far it can go right now. The housing cost to income ratio is another way of saying affordability. And if you look at San Francisco, housing costs as a percentage of income, 64%. Are you kidding me? Whereas down in Indianapolis, it's 18%. That's why we like markets like Indianapolis or smaller markets in Florida like Tampa. At the end of the day, there are some markets that are doing really well, and it won't come as a shock that those are the areas where most of the land has already been developed and therefore command a higher share of income. Nor is it surprising that people are leaving those areas for cities where their dollar goes further. And we're seeing a lot about migration and a lot of hot markets. We look at all markets in 5 areas. Are they very overvalued or fairly valued or undervalued or very undervalued? Well, right now, everything we see is in the overvalued or the fairly valued category, but it won't be long if prices continue to go up, and especially if interest rates get a bump, that we find that markets are all of a sudden very overvalued. And that is a function of what we call intrinsic value, which we don't have time to get into tonight. Now, will all these purchases of overvalued homes lead to future foreclosures? Really too early to tell in the US. We are going to see some foreclosures. And what we're going to see are other dominoes start to fall first. So the federal foreclosure moratorium is ended. So borrowers with federally backed loans can still receive pandemic forbearance protections until September 30th, which, by the way, is next week. So the homes currently in foreclosure and those with protections expiring at the end of the month should begin proceeding through the process. But here's the thing, there won't be a glut of them. And what there are necessary in order to increase the historically low inventory levels that we have right now. So it's more likely going to stabilize the supply-demand situation than exacerbate it. The price to rent ratio has skyrocketed this year. And that's the ratio that we look at as a benchmark for estimating, is it cheaper to own a property or to rent one if you're a renter and have the option to do both? Well, I can tell you this, single family rental prices in the US are increasing big time and across all tiers, and they weren't pre-COVID. So you really have to ask yourself again, why? They're up 7.5% on average. And if you look at the 7.5%, it's lower at the low tier. The lower rental homes are actually going up about 5.3%, where the higher price rentals are going up 9.6%. And some markets are absolutely crazy. If you look at all the major markets, if you look at the very bottom there, you'll see Boston and Chicago are actually negative. In other words, people are moving out and no one wants to rent, so rents are going down. But then you've got Phoenix at the top, where year over year rent rates have gone up 16.5%. And in Vegas, gone up 12.9%. It's unbelievable. So Boston, and of course, to a lesser extent, Chicago, but Boston has seen this decrease in their rent for 11 consecutive months now. New York, of course, is not favoring too well either. Apartment occupancy set a new all-time record of 96.9% in July. And with that kind of occupancy, there's going to be pressure that landlords are going to put on tenants to increase price or increase rent rather. Apartment asking rents as a result have shot up 8.3%. Now, how did you see that coming? Go back and look at what it was increasing by, 2 to 4%. And then all of a sudden it dropped. And now it's up at 8% or north of that. Makes no sense. So how can it sustain itself? I don't know. Here's what I do know. A number of the biggest metros posted 10% or greater year-over-year growth in asking rents. If you look at the annual rent growth of 20% in Phoenix in the multifamily space, or 15 to 19% in these many of these other markets, largely in Florida, Vegas, and California, and then the rent growth in other what are called secondary markets, what we're seeing is that almost all markets are going up except for the metros of San Francisco, San Jose, and New York. And of course, we talked about Boston earlier. So that was a lot to talk about. It was a lot to share with you. And of course, I went relatively fast because I had to in order to get through this in a reasonable time. But the question really then comes down to, what should you do about what you just learned? Well, I don't know about you, but I got news for you. If I were you, I'd cheat off me. In other words, take what we've shared with you tonight and do something about it. Take what we continue to do in terms of education for people to try to help understand what's going on in the market. But fundamentally, win the money game. Remember this triangle I drew for my sons over 30 years ago? Generate more cash, either active or passive or recurring. Accumulate more wealth by having more assets that both throw off income and go up in value. And keep it. Either put yourself in a position where you become a private lender, or you invest in real estate, or you invest in funds that do these things. Accumulate more wealth by trying to own more of that space, by being a private lender, for example, yourself, or being a real estate investor, or investing in technology companies. That's where you accumulate wealth through assets as opposed to cash flow that you're able to generate active, passive, and recurring, and then keep it. Now, a lot of people cut expenses. They have tax deductions like you have in Canada and we have in the US, or in my case, Puerto Rico. We have what are called 1031 exchanges, which are positive tax treatments for those that own real estate and want to exchange it. Well, I live in Puerto Rico because there are tax treaties here for Americans who move here, and I pay either 0% under one tax decree or 4% under another. That's crazy how much wealth you can accumulate by not giving it all away to taxation. And then these TFSAs, or Roth self-directed IRAs in the US, where you can actually, if you're smart, get into alternative investments like Christine does, but do it in a retirement fund. In our case, what we call self-directed Roths or IRAs. So that's what it's resulted in for me. I've gone from a trailer park for the first 20% of my life to having way more wealth and time, and living on the nicest 1 mile stretch of beach in the Caribbean and looking at that every day, while making double-digit passive recurring interest income, accumulating more wealth, keeping more, and doing it all from a backpack so that my effort to return ratio is the best. So cheat off me, do what I'm doing, and hopefully it'll help you get to where you're trying to go quicker. I will also, anytime I do any presentation, whether it's live or on a webinar, I provide my free epiphany. There's no book, there's no course, there's nothing, but I came up with a concept that I woke up in the middle of the night like Jerry Maguire and came up with an idea, and it's literally changed my life and put my family on a trajectory we could have never dreamed of, where now I go from the trailer park to my son building billion-dollar companies, and for us creating a community of what we call fewer, better people. Our fundamental thesis is that we should all be doing fewer, bigger things with fewer, better people through fewer, deeper relationships. How many people do you need like Christine in your life? You don't need that many. One's a good start. So at the end of the day, what I always like to do is offer gifts where there's nothing for sale, but I'll send you a free copy of my Power of Six white paper on what I believe is the biggest aha that's ever happened in my life, and it put us on a new trajectory. send you a replay of today's webinar, or Christine will. And if you're interested in receiving market alerts or invitations to future webinars, all you have to do is really just go to accessinsiders.com/Canada. Just know that this is really for serious investors who not only want the gifts that I'm offering, but kind of continued research and blueprints and strategies and opportunities for how to optimize your financial future. So just go to the site. You'll see that I'm welcoming you there. And all you'll need to do is complete a few questions, very simple ones, basic ones, to help us understand you. And then lastly, if you're interested, I'm going to pre-register you for my next webinar on private lending. Now, you don't have to come, you don't have to do it, but it's all part of kind of continuing education. And here's why I like it so much. And obviously, Christine has cracked the code on this, but I think you're going to like this one, Christine, because you probably haven't done this. How about some background? You see, in real estate, there are 6 F's. And in private lending, as Christine knows, you only need 1. So in real estate, to be a great investor, you have to find it, figure it, fund it, fix it, fill it, and flip it. And each one of those takes a different skill set. Have you ever thought about that? To find it, you got to be great in marketing. To figure it, you need to run numbers. To fund it, you got to raise capital. To fix it, you got to know how to do contractor work or hire contractors. To fill it, you got to learn property management. To flip it, you got to sell it. You realize there's 6 disciplines. So you see, flip this house on Canadian or American TV and think it's easy and you can roll out of bed and do that, only to find out that you got to have 6 skill sets. So no wonder people aren't as successful as they should be. Where if you're a lender like Christine and I are, you basically write a check and get a bigger one back. We have figured out how to fund it, how to vet the deal, how to vet the borrower, how to vet the market. If you can do that, and we know how to do it, create a workshop on it, at the end of the day, it gives you the best effort to return business you could ever want. Where if you compare it to the active investor and the private lender, flipping is so much more tedious and very risky compared to being a private lender, where you are in the perfect part of the capital stack, as it's called. So why do I tell you that? Well, not only because it's helpful to know, but because you can actually do it as a 3-year-old. So there's my 2 grandsons. That's Carter on the left, and that's James on the right. James has actually gotten better looking, by the way. Not that he wasn't at that time, but nevertheless. So my son, of course, is, Caucasian, and my daughter-in-law is Korean, and they are producing the best looking kids on the planet. And it turns out that for legacy purposes, I wanted to plant the seed of self-reliance and wealth in my grandsons, and to plant it even before they could understand it. So my sons and I decided to help my grandsons begin to grow their fortunes tax-free, starting at 1 and 3 years old. Sounds crazy, but in the US, you can open a self-directed Roth. I don't know if you can do the same thing in Canada, but for your kids in the US, as long as they have up to $6,000 in earned income, they can contribute to their retirement account from the minute they're born. But they don't know what they're doing. So you and I as parents help, and I, Grandpa, hire them under a modeling agreement, and I pay them income for me being able to show their photos here. So they are my advertisements. And as a result, I pay them modeling income, which they end up reinvesting with us in order to do what are called wrap loans. Now, we don't have time. I'll talk about this on the next webinar, but at the end of the day, look at this. My son, my grandson's uncle, my son, it made a 10.3% as the underlying lender, and my grandson made a 93% on his first deal. How would you like to make 93% annualized on the first deal you've ever done in real estate and you were 3 years old? I love it. So anyway, all right, I'll shut up. So to summarize, cheat off me, win the money game, be an insider. You see, when you're in the stock market and you do insider trading, you get thrown in jail. As an insider in real estate, you get filthy, stinking rich because you get the deal before somebody else does by knowing the people who have deals. Also go to accessinsiders.com/Canada, and I'll send you that free report that changed my life. It's just a white paper of several pages, but literally it's going to be powerful. And everybody who reads it says, my God, why didn't I think of that? And why don't you write a book? And I say, I'm too busy making money to write books. But anyway, I'll pre-register you for future webinars. The next one we've got is Just Be the Bank. And that is it. So look, I hope you enjoyed this. I hope it opened your mind to the possibilities. I hope you now understand that research isn't just nice, it's necessary. And when you've got research about where we are and what's likely to come next, and you know the strategies at any point in the market cycle, and you create a blueprint for each strategy, and then you execute, when you wonder how we've been as successful as we've been, adding zeros, now you know. So to receive future stuff like that, now you know where to go. And Christine, I'm good.
Thank you, David. Wow, this is really incredible pack of information. And for myself, I really like to have a copy, and I'm going to rewatch the whole presentation. There's so much to digest. And so I will let people actually spend some time typing the questions in the Q&A session and the chat box. And for the next 10 minutes, I will do some presentation about what we do, what I do. And after that, we'll come back to ask questions. I do have some questions for you too. So I'm going to share my computer screen.
Perfect.
So my story, I came to Canada in 1989 as an international student with $200 in my pocket and 2 suitcases. And I spent the first 10 years working in Canada in the banking and investment field as a financial advisor. In the later 21 years until now, I'm in the mortgage industry. So I personally closed over 10,000 mortgages. And we just did a data migration. That's what we got merge everything together. So 10,000 mortgages. So I'm very proud to say I'm a mortgage expert. So I've won over really lots of prizes, awards in the industry, in the Canadian mortgage industry. Especially, I'm very proud to be the 3 times award winner for the Alternative Mortgage Broker of the Year by the Canadian Mortgage Award, and also in the past few years. And I've been winning a few times the award as a Woman of the Influence in the mortgage industry. 2 things in my business. One is mortgage brokerage, mortgage brokering. So we have a company called Money Broker Canada. So Money Broker Canada is a full service mortgage brokerage in Canada. So we provide residential, commercial, private mortgages. We do a lot of private mortgages. And also the new product like a reverse mortgage. And we also provide business loan, line of credit, even the government BCAT loans, even equipment leasing. So anything with money, we do that. So that's one part of our business. The second part of the business is private lending, as what Dave was just doing a presentation. So we start a company called Ready Capital Mortgage Investment Trust. Mortgage Investment Trust is a mutual fund trust. We're registered in Ontario. We provide the investment available to all Canadians. All investment are mortgage secured by real estate properties. Unlike David, in the States, I think David have 10 different funds. We only have 1 fund, and that fund is for passive investment. For passive investor, have passive investment returns. And so just a brief feature about our Ready Capital Mortgage Investment Trust. It's a mutual fund trust. It's very secure. All investment are secured by mortgages with real estate properties. It's passive investment for investors. Everybody receive interest income. By the end of the year, you only receive T3. So we don't do any capital investment. So we have no capital gains, no dividends. Everything 100% is interest income. And we give monthly distributions. So for people who like to have a regular cash flow, that's perfect. We have a fixed monthly distributions based on our projected income, projected returns of 8% per year, sorry. So monthly you'll receive income, or you can reinvest it as we can do a compound interest investment for you. And it's very flexible. This fund has no locking period. You can withdraw your money anytime with 2 months interest. So if you have money, you don't know where to put it, as what David was saying right now, the market has lots of uncertainty. He just mentioned, which I've taken notes, the best way to put your money, the best place to put your money is private lending. So you can give the money to us. We help you to lend it out, making passive income. But when you need it, when you think the market is turning over, you want to use the money to invest yourself, give us 2 months notice. You can withdraw your money. Also, the fund, because we are expert in doing a private lending, we found the best deals, we found the best secure deals. We have a very good return for our investors. The projected income return is over 8% per year. And by the end of the year, after we do our audit financial reports, we'll give extra distribution to the investors. So monthly, you'll receive the fixed income based on 8% projected return. And because we are mutual fund trust, so it's a very regulated, unlike the private funds, we are very regulated investment vehicle, because you invest with ready capital. We are not, you're not a LP or the limited shareholder. You're buying a unit price, you're buying units from our fund. So you are a passive investor. So monthly, we're going to file our net value monthly to our security commission. And monthly, you're going to receive your investment reports. And we have multiple investment options for you. You can do in your cash investment. You can use your personal account or business account. You can invest your tax saving vehicle as RSP and TFSA. And for our investors, because it's a mutual fund trust, we encourage everybody to start saving. So the minimum investment starting from 25,000. Even in Ontario, we have a special promotion for Ontario residents to invest, starting with $5,000. So you can invest for your kids, for the future. Okay, so that's my brief introduction of what we do, what I do. And so 2 companies we have, Money Broker Canada, that's our brokerage, and Ready Capital Mortgage Investment Trust, that's our fund. Everything we do, 100% of investment is private lending. And if you want to reach us, you can just save the screen, you can connect with me with the WeChat or go on our website. Okay, so I will give the floor back to David. Let's see if there's any questions. Okay, there's a few questions in the Q&A box and a couple of questions in the chat box. So I think David, I'm going to take this privilege. I'm going to ask a couple of pressing questions for myself first before you answer any other people's questions. So I want to know, David, from what's your investment? What's your strategy to give the best yield from your funds, to achieve the best yield for your investment funds?
Well, you're talking about for our investment funds. What do we like, or what do we do, or?
Right. Yeah. So tell us a little bit more about your funds.
Sure. And this isn't about trying to raise money, so I don't want anyone to think that that's the case. But when we look at investing, we look at 3 things: real estate investing, private lending, and then what we call early stage technology companies that grow into the Ubers or the Airbnbs of the world. And in our experience, what we've seen is this, that when you buy at the right time in real estate, it sounds crazy, but you can literally double your money every year. Now, what do I mean by that? Well, let's say you bought a $100,000 home, 100,000 Canadian, 100,000 US, it doesn't matter. Buy a $100,000 home. And let's say that you put 10% down. Now you really have $10,000 of your money and the bank has $90,000 of their money. Let's say the home, the $100,000 home appreciates 10% in a year, which has happened recently, hasn't it? So $10,000 in appreciation on your $10,000 investment is 100% return. You literally doubled your money in 1 year through what's called appreciation and leverage. And leveraged appreciation is the key to wealth in real estate. Those two words, that's it. You get those right, you'll make a fortune. Forget everybody else who's told you it's all about cash flow. It's great if you're going to invest in a fund like Christine's, which throws off cash flow when you don't do anything. But if you're going to do something, use leverage and get appreciation in the right markets. So that's real estate. Private lending, we happen to like, as does Christine. We both are private lenders, and it's because we can get a double-digit return. And of course, Christine is able to get great returns too, and some of it she shares with you, and some of it she keeps for herself, as every fund manager does. So private lending allows us to double our net worth every 4.8 years on average. And then there's technology. Well, we're looking to place bets on companies that could be massive companies. I mean, look at Christine's company. Who would have ever thought when she started out, she'd be where she is? Who would have ever bet on me when I was in a trailer park? Nobody in their right mind, I'll tell you. But it's turned out to be amazing. And so we're looking for founders like you listening, or Christine, or people who can build great companies, but that they've got a technology element like Airbnb did. Think about Airbnb and Uber. What do they own? Nothing. Somebody else owns the car. Somebody else owns the rental property. And all they are is basically an enabler. They allow people to connect in a marketplace. God, do I love that model. So we've been fortunate to invest in companies that started with nothing and have become billion-dollar companies, several of them now. And so we like real estate, we like private lending, and we like to swing for the fences in baseball and try to hit a home run on those big companies, the little companies that become big ones. So I hope that makes sense.
Yeah, so yeah, three things. So I summarize. So you invest in real estate, private lending, and game-changing technologies.
That's it. You got it.
Perfect. So for those other people who are sitting here listening to your presentation, and I think they all have a same question I want to ask you again. You didn't expand that in your presentation. So what was your big breakthrough when you turn your life around? Like you were in the trailer park. How where you suddenly start?
Yeah, I think it's a great question. And I get asked that a fair amount. And I would say that there's not any one time in my life, but I'll give you a couple of them that just come to mind. The first time was when I was in that trailer park, and my dad was an iron worker. So he would help build bridges, but, he was just a hardworking, old school German guy. And so he would, pound, on bridges and do what was called riveting, and basically connect bridges and that sort of thing. And it was backbreaking work, and he was way up in the air. Well, one time he was working on the Sears Tower in Chicago, and he fell from the 5th floor because some people had laid faulty concrete. So when he fell, he was injured quite badly, and he was out of work for 22 months. Well, we had no money, and there was no welfare. There was none of the stuff that we have today. And so my mom would have to wash people's clothes in the trailer park, and I would mow their grass, and we would somehow put together enough money to eat mayonnaise sandwiches. Bread with mayonnaise sandwiches every day for 22 months. And we couldn't afford 3 sandwiches a day, just 2. And you think back at times like that, you can either give up or you can decide you've got a hungry, burning desire to be rich. And it's not just richness in terms of money, it's richness in terms of all the things that money and other things enable. So look at you. I mean, look where you came from. And then all of a sudden you had some deep burning desire inside you to get to where you wanted to be and didn't want to go back there. And that's really one of my big breakthroughs. The other breakthrough that may have been obvious tonight is when I was invited to speak at Harvard. And you know, it would have been one thing to have spoken there in 2005 when everybody thought I was nuts and never go back again. But I believed that the market was going to crash. And I showed all the research, but nobody believed the research. And so I kept doing it. And what I really realized is that being a contrarian is having the courage to believe you're right when everybody on the planet thinks you're wrong. And as I always tell people, you can be contrarian, and if you're wrong, you're an idiot. But if you're contrarian and you're right, all of a sudden you become a genius. Well, that was one of my big breakthroughs because I got a lot of people following me, and then they wanted to invest. And now we've done 10 funds over the course of 12 years with my sons. We've never lost a penny of investor money. And so now you get a break and you turn it into a breakthrough. And that's the message for everybody listening. It's one thing to get a break, but if you don't do anything with it, what's the point? It's one thing to come to a webinar like this and learn a lot of information and strategies and stuff that it took me forever to figure out. And you get to learn it in one setting, but if you don't do anything, it doesn't matter. So I think that's the important thing is take breaks that you're given, realize there are opportunities to have breakthroughs and really just have an amazing life.
Yeah. So it's not whatever you learn, it's whatever you do, you add on to it.
Yeah. Yeah. In fact, I'll give you a quote that my son was just quoted, I think in Forbes or something. He said, ideas are a dime a dozen. The magic happens in execution. Think about all the things in your life where you say, you know, God, somebody should do this. And then 6 months later, you see it and you say, I thought of that. Well, you didn't do anything. So it doesn't matter if you think about it. It doesn't matter if you have a great idea. If you don't do anything about it, it's nothing. That's what I think.
We actually, it's 9:30. There's a few questions. Dave, you want to choose a few questions you want to answer or you want to?
Sure. Sure, I'll answer. How about if we give it 10 minutes of the questions? How's that?
Okay.
Another 10 minutes.
Okay. So can you see the questions in the Q&A session, the chat box? Or do you want to?
Let me click on the chat box. I didn't even have it open. All right. I don't even know where to start. We got a long list, I think, here. Well, I'll start. How can we be that lucky, just like you, to find the right timing? I don't think it's luck. I think it's skill. Remember, I'm spending a lot of money on data and research in order to come to conclusions about the right time. So here's my question, and I asked you guys this earlier. Let's see how many of us get it right. What's more important, to get in the market at the right time or get out of the market? So type in the chat box. What's more important, to get in at the right time or get out at the right time? What do you think? Out, 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 both. Come on, Wendy, you can't cheat. All right, got ins, in, outs. All right, so we've got out as coming up, and some of you say the same. Well, it's definitely out. Why? Because let's go back to 2005. I speak at Harvard. I say we should get out of the market, and I thought that the market would peak in 2006. Guess what? The market fooled me. It peaked in 2007. And that's why I always tell people, when you're forecasting, your estimates are always wrong. By definition, they're wrong because they're estimates. The question is, by how much are you off and in which direction? We, or I, have always been off in the right direction by a little bit. So as long as I can, in 2006, get out of the market, and it doesn't peak until 2007, but I got out, what if I tried to get out in 2007? You see, at some point, the market starts softening, and here's the problem. Then you don't have buyers. I want to sell when I have buyers. And that's before the market peaks. Now let's talk about now. The market peaked in January of 2012. Now, if you got in a little late, all right, you didn't get in early, you didn't get in right on time, you got in a little late. What if you got in a year later and the market went up 10%? Who cares? The market's tripled. So it's so much more important to get out of the market at the right time. So most of you got it right. So congratulations on that. And for those who said the same, you're just trying to cheat. Okay, let me see. For the best, I feel bad because some are popping in now, and yet there are some that I should be going back. But for the best return in investing real estate, do you find that pre-constructions are a good option? Yes, but at the right time in the market cycle. Why? Because remember when I did that deal that you were hearing me talk about, that deal in Las Vegas? I went under contract in 2002. Very, 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 very few people even knew what a pre-construction agreement was. And it was basically an agreement where I would sign a contract saying, I want this home, and I would put down earnest money, which, by the way, back then it was $500. Imagine making $150,000 on your $500 investment and doing that 100 times. It was crazy. Anyway, but just imagine that you contract in 2002. I didn't want to contract on something that was going to be ready in 30 days because I didn't want it. I didn't want something in 6 months or 9 months or a year. I wanted something in the last phase of the development. And so that's what I did. I bought several homes, but I didn't close on them. I took them under contract in phase 1 that would be built in phase 4. Now, why was that a good idea for the developer? Well, he sold a home on paper, and he was able to take my paper, my agreement, and go to the bank and get construction financing. So I did him a favor by buying multiple homes, and he did me a favor by not only letting me go under contract for something that wouldn't be built for 3 or 4 years, but he gave me a discount because I bought as many homes as I did. It's like cheating, only legal.
But actually in Canada, there's actually, I think we have some risky situations. Some developers, they sold a home in a cheaper price a few years ago, but because everything increased so much, the construction costs or the market, the land value, everything else, so they decided to fold the company. So all the investors losing all the opportunities otherwise they are earned in investing in something else. So it's very important when you buy pre-construction home, you have to find a very reputable builder, or the builders who will now bankrupt in a few years.
Yeah, and I think let's take this one step further because I really think it's instructive for everyone. What if I would have bought a home at that point, right? And I closed on the home in 2006 when I flipped it. Well, I knew I didn't want to do that because I knew where we were in the market, and I had just predicted a year before it was going to crash. So I was trying to get out quickly. I didn't get out of all my pre-construction agreements. So Christine, how much did I lose on a pre-construction agreement that I didn't get out of?
Just the deposit.
$500.
Yeah.
Who cares, right? But when I did hit it, what did I make? 150,000. Well, that's a 300x return on my money.
That's a big difference. In
Yeah.
Canada, we're not allowed $500 deposit. We have to have minimum 5%. So.
Well, and it's different now, even in the US. The deposits are probably not 5%, but they're higher. But remember, think about back in 2006. We forget that that's 16 years ago. So back then, if you went to a contractor, what did the builder want? He wanted a contract. He didn't want the earnest money. He can't even touch the earnest money. He wants a contract. So I was able to negotiate on a volume basis, a low EMD, earnest money deposit, and a reduced price where he's still at margin because I don't want him to go broke, but I was able to get a property, 4 years from now. So that there are very few times in a market cycle when you have that opportunity, but when you do, oh my God, I mean, all you're doing is controlling an asset for 4 years that you have $500 in and no taxes, no utilities, no insurance, no homeowners association, nothing.
See, only in US, there's so many, so much more investment opportunities. That's why we are learning what US market can provide us.
Yeah. Yeah. Some folks are saying 15% deposit in Canada. And again, depends. Remember, most people who put deposit money down now are homeowners. So homeowners are generally expected to put more down, whether it's earnest money or whether it's down money in the transaction, where we investors don't want to put any money down for anything. We do it because we have to, or we borrow it because we know we have leverage. We go to Christine because we know that she offers good rates and it gives us the opportunity to get more of something that we otherwise wouldn't have if we didn't have her money. And so everybody needs somebody in the transaction. And golly, I don't even know where to start. So many questions. Christine, you're going to have to help me.
No, you choose a few you would like to, you found this interesting, you would like to answer.
Do I foresee the opportunities of buy, fix, flip properties coming back in Vegas? What's my thoughts on Vegas rental market, whether it can keep its steam for a while? Look, no rental market can continue to go up 12.9%, which is what Vegas has done in the last year. No rental market can go up 15.6%. Remember, if rents continue to climb at that rate, people will go to a market where they can buy and not have to rent ever again, and then control their own destiny. Why do renters rent? Well, most people rent because they can't afford to buy. And so when you price them out of the market, because for no reason, all of a sudden rents go up 12 or 15% in 1 year, think about that. Think about this for a minute. A $1,500 or $1,500 a month rent, if it were in Phoenix, is going up $300. That's nuts. I mean, there's just no way. Normally you'd see a 2 or 3 or 4% increase, but not a 20% increase. And so do I think it's going to lose its steam? Yeah, I think it's going to lose its steam. We were buying in 2010, 2009, 10, 11, 12. There were days where we were buying 3 homes at the auction in a day. And you saw the prices we were paying for them. And so when you're at or near a bottom of a market, what are you going to get? You're going to get the most cash flow you'll ever have on real estate because you bought it so cheap. And you can either finance it or you can buy it all cash. $61,000 at an auction, really? Number 2, you're at or near the bottom, so you get so much upside. So people always say, why did you pick Vegas? And I say, it had everything every investor would ever want at the bottom of a market. 68% of homes were underwater. So I could buy those at the auction when no one was at the auction for 40 cents on the dollar. Number 2, and you're going to be able to answer this question for me, Christine. Does everybody in China know where Las Vegas is? Have they all heard of it?
Of course.
Okay. Has everybody in China heard of Sacramento, California?
Not really. Oh.
And it's the state capital in California. Nobody's ever heard of it in China, but everybody's heard of Las Vegas. So I decided that there were going to be 2 markets for me where I was going to make the most amount of money on the homes that we bought and flipped. Which 2 countries do you think are the biggest markets for Las Vegas real estate at the bottom of the market? China and Canada. So almost all of our inventory was sold to either Chinese Americans who came over on an EB-5 agreement. Are you familiar with those?
Yep. Yeah.
And so, you know, they were moving to Southern California and wanted homes in Vegas. Everybody wanted to gamble. And so I want you to think through my thought process here, and hopefully it'll be instructive for everyone. And then I'll let you go because I know you all have better things to do than listen to me all night. But imagine that you buy homes that used to be $287,000 4 years ago, and you buy them for 60 to 65. You put 5 to 15 in rehab into them, and now your all-in cost is $76,000, and it used to be 287. Now, what can you do with a $76,000 home? You can rent it and make a fortune. You can sell it and really do well, either to investors or homeowners. You can sell it all cash, or you can sell it financed. You can sell it in the US, or you can sell it to Canada and China. You have every possible exit option you could ever want. And if everything else doesn't work, you hold it and cash flow it. That's why I chose Vegas. It's why we went all in Las Vegas and why we predicted it would be the #1 buy market by 2010 in 2008. So I think it's important to always think as an investor about what your exit strategies are going to be and what your risk aversion plan is. So when you're at $76,000, how much lower can it go than 76,000? I mean, just, it's like half the cost of construction or less. So you look at something like that, and then you just finally realize I don't have any downside risk. I'm literally at a time, the when, I'm at a location, the where I have no downside risk because I've mitigated everything by having homeowners and investors buy from Canada and from China and from the US, whether they pay all cash or they finance it, or if worse comes to worse, I just rent it. And so that's why we're buying 3 homes a day.
Especially when we're looking at now, that's of course a win-win-win situation. But so now at this moment, like myself and all the listeners today here, they all want to find out where to put money. And the whole past hour, you're talking about that too. So we will treat it on your brain. That's the best way to
You're welcome to.
Yeah. Another question, maybe you have a very short answer. What do you think about land? Is it a good investment?
What do I think? What?
Land. Is
land.
It the land?
I'm personally not a big fan of land at this time in the market cycle. What's happening is, first, land was very expensive in the major metros. So people moved out to the secondary markets, and now they're moving out to the tertiary markets. People don't want to live that far away. They want to live in the secondary markets, but they're being pushed out further and further and further. So if people ever start working back in the city, then that land is going to be worth less. And here's the thing. When the market corrects, the one thing that gets crushed is land. Because basically, when people stop buying homes, there's no need for anyone to speculate on land development. And so over the last 3 or 4 years, land has been on fire. Even over the last year and a half, it's been, in my opinion, artificially on fire. So markets are so hot, and land and builders are building like crazy now. That always makes me nervous because it reminds me of exactly the same thing that happened in 2005 and 6. So, we're 10 years into a market cycle. How long do cycles generally last? 7 to 10 years tops. We're 10 years in. So I'm not saying it's going to crash. I've said that before, but it's got to correct because, it all starts with what homeowners are willing to pay. Because remember, investors are just a sliver of the overall real estate market. Roughly 90% are homeowners and 10% are investors. So those homeowners make all the decisions for us investors. When they decide they can't afford something because sales prices are too high, or interest rates go up, or their income stays the same or goes down, then they don't have a choice. They have to do something. And that something is to stop buying and either start renting or move back in with their parents or whatever it happens to be. And we saw that happen in 1979 and 80 when the market collapsed here in the US. In 1989 and 90, same thing. And in 2005 and 7. And so we saw the same thing happen, or I believe that in 2019, we would have had a recession in 2020 anyway, but COVID just blew it all up. So anyway, long-winded explanation, but there you go.
Yeah, I actually have a very short answer. Usually, I go ask those questions all the time. For me, land is very risky investment if you need to borrow, because it's very costly to borrow on land. And also, there's no cash flow unless you do a really long-term investment to hold it for a long time. If you lots of cash, you don't know where to put it safely. You put on in land, at least you hold your value most of the time if you have long enough time span, but it's not for short term, it's not for people who need to borrow.
Yeah, and I think you just answered part of it by saying, does land cash flow?
Yeah.
No. So does land have expenses? Yeah, it's called taxes and maintenance on the land.
Yeah.
So if you have negative cash flow while you're holding land, there's only one way to make money on it: appreciation. That's to be able to sell it for more than you bought it for.
Yeah.
And not bleed to death in the process with expenses. Well, what happens when demand for homes dry up? Land dries up immediately.
Yeah.
And the thing about land, unlike everything else, is if I buy a home and I want to repair it and flip it, I can do that in 3 to 6 months. How long does it take me on land? If I'm with raw land, first I've got to get it permitted, and then go through an entitlement process, and then go through architectural drawings, and then go through a development process, and then be able to build all the infrastructure. And then, holy crap. Now, it just takes too long to get out of something like that. When you're at the bottom of the market, I'm in. Give me all the land I can get when I'm at or near the bottom of the market. So if you think we're at or near the bottom of the market, those of you listening, you should go all in on land.
Okay. One more question or no question?
One more, and that's my final offer.
Okay. We have to choose. You want to see what's the last one? There's a comment. I'm in US. Would like to learn private lending in US. I guess that's a comment. How do we best to learn? I guess you go to the website and type in that.
Let me do this. I rarely put anything in the chat box, so if I screw it up, tell me. But I will go just be the bank.com. See if that worked. Oh, I spelled it wrong. See, I told you. Just be the bank.com. All right, so you can go there, click on it, and go ahead. Down at the bottom is a submission form, and we'll send you information. Or you really ought to go to accessinsiders.com/Canada. If you haven't already done that, you may never hear from me again. So if you'd rather not hear from me again, don't go there. But if you would, like Christine and I do this sort of thing, then you got to tell me. And that's where, and by the way, the only reason we did that workshop is because everybody asked for it, because people like Christine and I have learned how to become private lenders, and it's just been amazing. But most people, they want to invest in a fund and let Christine do all the work. And that's why we created our funds 12 years ago in private lending, when we could barely spell private lending, but we knew there was an opportunity. I still can't believe anybody trusted us with their money, but they did. And now we've done 8,000 deals just in private lending, not including those that Josh did with Lending Home when he built $1 billion company. I think 30 or 40,000 of those now. So that's less than 10 years. Well, look at you. I mean, look how fast you've grown and how many deals you've done.
Yeah, so, I can't believe it. We did I can't believe it's over 10,000 deals. Like we have the two computer system merge and copy all the files together. That's unbelievable. Like 21 years. So
nuts. Good for you.
Well, thank you very much, Stech. I really, for myself, I thoroughly enjoyed this seminar, and I'm sure most of the audience, we still have over 120 people online. So that's incredible. And thank you again. And if anyone want to get more information, get to learn more from Dave, just follow the instruction on the website and send us an email, send us a text, and go on our website. And thank you very much. And happy Mid-Autumn Festival to all of you. Thank you, Dave.
Yeah, and to thank you. And maybe next time we won't do this on a holiday, huh?
Yeah, we didn't know we choose a day, and I thought that's a good day. It is a good day.
Oh, well, that's just you and me. We're working for a living while everybody else is having fun. But oh, well, we're making money, doing good, and having fun all at the same time. I appreciate you, Christine.
Thank you so much, Dave.
See
Thank you,
ya.
everyone. Okay.
Bye. Thanks for everybody.
Thank you.